Now, in economic news, research institutions continue to lower their growth forecast for the Korean economy, not only for this year, but also for the next. And with deflation woes mounting, most private institutions say inflation will only stay within the 1% range next year. That's lower than the government's outlook of 2%, and this could affect domestic sentiment in 2015, as our Song Ji-son reports.
Slow growth and low inflation are making it hard for Seoul to reach its growth forecast this year. Korea's economic recovery has lost momentum since April's deadly ferry disaster, which dented domestic sentiment, and it appears the trend may continue well into next year. In July, Seoul slashed its growth forecast for this year from 4.1 to 3.7%. But that's still higher than the market median, which stands at 3.5%, according to financial data released Thursday. It's the same story for next year's growth outlook. While the Korean economy is expected to grow at a relatively faster rate compared to this year, the Korean government stands alone with a forecast of 4%, with others expecting the figure to fall in the 3% range. The inflation forecast for next year from private institutions rests in the 1% range, nearly a percentage point below the government's outlook. That suggests the inflation will hover in the 1% range for the third consecutive year. Slowing domestic demand coupled with falling oil prices will only compound the issue, which may sound like a good news for consumers, but not in the long run.
Once prices continue to fall, both consumption and investments shrink on expectations they will fall even more, leading to further deflation. To avoid such a recession, the government must facilitate the domestic economy in a way that boosts both growth and prices.
A weak Japanese yen, slowing growth in China, as well as an end to U.S. quantitative easing are also casting a shadow on the Korean economy as downside risks for the coming year. Song Ji-son, Arirang News.